Hello, everyone, and welcome to WooStream, where we are bringing Willamette to you. I'm Eric Lasan, and for today's presentation, Bob Heck will discuss retirement planning during the accumulation phase of life and how to manage in these uncertain times. Bob is an alum from the class of 2007 and also earned his MBA from Willamette in 2011. He currently serves as member at large and the incoming vice president on the Alumni Board of Directors, of which he's been a member since 2015. Serving as wealth advisor at Kiley Juergens Wealth Management, LLC, Bob specializes in portfolio management, financial planning, pension consulting, investment advisory services, leadership development, and mentoring, among other areas. I should also mention that Bob serves as the president for the Hands-On Children's Museum in Olympia, Washington as well. So thanks, Bob, for joining us, and the floor is all yours.
Excellent. Thanks, Eric, very much. Appreciate the intro. Appreciate everybody who is behind the scenes to make WooStream happen, and looking forward to it. So I will share our presentation today. As some of you might know, we're in installment 2 of a 3-part series for WooStream. Overarching theme, panic is not a financial planning strategy. Today's segment is going to focus on retirement, saving in retirement during COVID-19, or really any pandemic, or really at any point in time. I'm Bob, and I'm really happy to be here today. As Eric mentioned, I came to Willamette from Olympia, Washington, and graduated in 2007 in English. Stuck around for a bit. Some of you might remember I was over in the annual giving office, and then from there got recruited to join the professional MBA program at Atkinson, and in 2011 walked away with my MBA. So proud dual degree alum. And it was the time at Atkinson really opened my eyes up, and I looked a little bit more at moving from nonprofit to maybe something in the private sector. And after coming home to Olympia for a bit, going to DC, doing some campaign work, came back and landed at Kiley Juergens Wealth Management as a wealth advisor in 2013. We are a independent SEC-regulated registered investment advisory firm here in Olympia, co-owned and founded by John Kiley and Marty Juergens. And when I started, I was a 4th or 5th employee, and now we're at 10. And I've just seen some tremendous growth here. And along the way, stood for and sat for the financial Certified Financial Planning CFP exam, and received that in 2017. Which is a little bit like an MBA or another advanced degree for planners. And then in 2019 was promoted to principal advisor here at the firm. So we've got 2 co-owners and 2 principals. And the work we do is especially appropriate to complement what my friends and fellow Willamette board members are doing. We had Barry Nelson yesterday talk about kind of context of what's going on and what has happened to bring us to where we are this year in the markets. And then our friend Matt Benjamin will talk about kind of business, more business focused tomorrow. But from my perspective, our firm has a couple different areas of specialty. We work a lot with individuals, but also we've got a pretty big focus on employer retirement plans. And so that's where I'll take a lot of my comments today. And then we work a lot with nonprofits as well. We've got over 40 different nonprofits that we work with, and we will either manage their investments or we'll manage their retirement plan. And for about a third of them, we'll manage both. So between the 3 of us, we think we got some good knowledge to share with you. Looking ahead at how we're going to spend the next 20 or so minutes before we get to questions, here's a roadmap for what I would like to cover. Ideally, we'll start out with saving for retirement, kind of answer some questions and give you some sense on how to create a plan. Talk about strategies once we figure out how to and where we're going to save. Touch on risk tolerance and time horizon. I think 2 pieces to remember in especially periods of market volatility. I'll touch on compound interest, and then we'll talk about, from here and from this segment of 3 different web series, where do you go? How do you continue getting more advice? Where can you find more information about these topics and more? And then we'll open up for questions. All along the way, I've put in some graphics from Carl Richards, is a financial advisor that wrote a book called The Behavior Gap. He does a real good job, I think, of distilling down complex ideas, putting them on a napkin sketch. And really, there's going to be a lot of questions or a lot of what ifs or there's just a lot of data between where we are today and where we want to go. But essentially, I'll do my best to distill it down and try and make sense of it for him. I think he does a good job doing that with pictures as well. So when we think about saving for retirement, I boil it down with my clients and talk about really three big important areas. And before we get to the savings piece, we'll always start with, do you have a budget? Asking, do you know how much, essentially the budget, and it could be a 4-letter word, depending on how you look at it. But there's, the important piece of a budget. How much do I have coming in? And how much do I have going out every single month? And ideally, what I want to work with clients on is identifying what that discretion or what that extra over what goes out and what can you save and how do we save it effectively. And looking at different plans and different budgets. Sometimes we run a deficit every month and sometimes we have a really big surplus. But ultimately understanding what's coming in, what's going out before it happens so that we're looking forward to May instead of back into April is a really important first step in building your retirement saving and building a plan. Second piece is paying yourself first. You are doing the majority of work on earning your income and definitely should receive the first dollars. And that's really important. And you can do that in a variety of ways. But at some point, we're all going to wake up, and maybe it was this morning, maybe it was yesterday, maybe it will be tomorrow, but we'll wake up and we'll realize, I don't know if I want to go to work anymore. And hopefully what I can help my clients with, hopefully what we can help you with in these series is trying to figure out a way to make sure that every single pay period, you're going to take some of that and pay yourself first. Ideally into a retirement plan, but it's not always the first step that I recommend to clients. And that's where we get into the emergency fund. Ideally, I want everybody to stay on track. And retirement savings can be a little bit daunting when we look at how much we need to save and what we have the capacity to save. And so the emergency fund really is that first firewall for every single person that I'm talking with. And maybe it's $1,000, maybe it's the ultimate goal of 3 to 6 months of discretionary income or discretionary expenses. But somewhere in there is where we want to start. If you haven't built an emergency fund, again, just like the budget, I think that's foundational. What the emergency fund will let us do is stay on track. And you can say emergency fund, you could say the oh crap fund. Oh crap, the car happened, or oh crap, the water heater blew out, or something. There's going to be something in life inherently about being an adult and having these things happen that we're going to need some cash for. And so that's that first firewall. And what it does is it lets us continue to save into retirement plans or into other vehicles all along the way. So I'd say as we think about how to set up saving correctly, get yourself a budget. Pay yourself first and really prioritize that above everything else and build that emergency fund. Because as the graphic here shows, there's a lot of stuff out there that matters. There's a lot of things that we can control, but the overlap in that Venn diagram is very, very, very tiny. And if we really distill it down, we can kind of make sense of all the noise and other pieces out there that could distract us from our ultimate goal of building a retirement nest egg. As we think of strategies to save, how do we get there? Well, the first is, I think, ultimately the emergency fund. And maybe this is $1,000, under your mattress. The more under your mattress, probably the worse you're going to sleep. So I don't recommend too much more than that. But maybe it's in a safe, maybe it's in a safety deposit box, maybe it's in a separate, online checking account that you can't access very easily, but you can access. And ultimately find a way in which you can build up and get that $1,000 and put it aside so that it's there, you can access it when you need to. Give yourself permission to do that, but also don't want to get at it too frequently for discretionary fund expenses that might not be within a plan. So find a strategy there, and then don't hesitate to use it when you do need to use it. Once we check the emergency fund off of our list, for those of us, some of us are going to be with employers that offer their own retirement plan, as well as others are going to be with folks in maybe it's self-employed or with an employer that doesn't have a retirement plan. So one of the saving vehicles that I'm really excited to share information on is either an IRA or a Roth IRA. And these you can set up as long as you've got W-2 or taxable income. You can set one up, go to Vanguard, go to Fidelity, work with an advisor. Pretty easy to transport into. And it allows you, these two vehicles allow you to save up to $6,000 in terms of money that is earmarked for retirement. If you're 50 or over, you can save $7,000 into each of these accounts per year. And that's pretty exciting. The IRA, obviously this lets you put money in pre-income tax. So any money you put into an IRA comes off the taxable income that gets reported to the IRS every single year. And that, of course, that account will grow over time. No taxes will be due on any of the growth in that account. And then in retirement, 59 and a half or older, you'll be able to access those funds. You'll pay income tax in the future when you access that money, but it's a nice way to start saving and get a tax preferred way of creating your account and putting money to work for you over long periods of time. The other complement is the Roth IRA. And this is really exciting because what it does is it lets you pay the tax today. So generally, rule of thumb is if you're about 35 or younger, it might be a good idea to explore your Roth options because usually you're in the early part of your career. You can set one up at any time, and it allows you to pay taxes, your income tax today, and then the investments grow without any taxes due. And in the future, you get income from and any distribution from this account without any taxes to you at all, which is really great. Because what we think we know is that taxes are going to be continually increasing as it gets more expensive to run the economy and run the country. But both these accounts offer a really great way, if you don't have an employer plan, to jumpstart and have a vehicle to save. The other alternative would be saving just in an account, in an investment account, or maybe a betterment account or something. And what I shy away from there is it's not a tax sheltered account. It's not as efficient because you're going to pay some sort of a tax on that investment account outside of a retirement plan every single year. It's a great idea to add to the mix, but as we're looking at kind of early and mid-career strategies, I think the IRA or the Roth IRA are really great types of accounts. We're going to talk about investments to go in those accounts on the next slide. And then for those of us who work for employers with a 401k or a 403b or a simple or a SEP or some sort of employer-sponsored plan, that is a really great vehicle to save into as well. A couple reasons why. First, you've got salary deferrals. So with the IRA and the Roth, you write a check and you deposit it, and then you have to show on your taxes that you made that money to go into the account. With employer plans, you can sign up with your HR office, you enroll, you create your account, and then you fill out a salary deferral form. So every pay period, you've got the opportunity to put in either a percent or a dollar amount into your account. And over a long period of time, we'll see how that can work to your advantage. And some accounts and some employers, not all, will offer some sort of a matching or employer contribution. In my line of work, I don't get to use the word guarantee ever. But if there is an employer match, say a dollar for dollar match up to 4% of your salary, well, every dollar and every dollar amount you put in up to 4% of your salary gets matched. You get a guarantee boost in what you're putting away. And that's just a tremendous benefit to you. Obviously, for the employer, there's a tax write-off and a benefit to them. And not all plans have this, but if you do have it, it's something that we really encourage all of our clients, and I encourage anyone to take advantage of essentially free money that's out there, can really jumpstart. And why is that important? Well, number 4, start with some sort of a percent increase annually. Ultimately, our advice is, and my advice to you is figure out a way to save 10% of your gross income every single year. And if you can do that for the majority of your working years in retirement, you're likely going to have a pretty significant nest egg and an account to draw from. It doesn't take getting to 10% immediately. You don't have to start there, but start with some sort of percent. Look at that budget, figure out, okay, how do I pay rent? How do I pay my mortgage? How do I put food on the table? What's left over? And maybe you start at 1% and every 6 months you increase, or maybe you start at 3% and every year you're increasing 1%. But find a way to start, and then every 12 months, either on your birthday or on your employment anniversary, go to HR, ask for the form, increase 1%. And where 3 and 4 really go together, I think, really well, is if you've got that matching money. You start with 3%. or 4%, and the employer is going to match, well, that doubles it right there, and you get closer. You get either 6 or 8%. You can really make your investment and your contribution double and stretch a lot farther, which gets us to ultimately that 10% goal and beyond. One piece that we don't see, one strategy we don't see on this list is pensions. It isn't to say that you can't have a pension eligible position, and we have a lot of clients who have pensions, but they're not as prevalent. And savings is really morphed into, especially for those younger and starting out in the workforce, saving is really on you as an individual. And so these are some strategies that hopefully you can leverage to build your nest egg and go from there. And again, this graphic, increasing the amount you save, that's what I want you to hear on this slide. The best investment is out there. And believe me, if I knew what the best investment was, I would probably not be in an office working with clients. I'd probably have made that investment and be on a beach in Hawaii. And then always be wary of the brother-in-law advice or the sister-in-law advice. Everybody's going to have a story, hopefully, if you have a career in the lifetime of investing, of hitting it right or hearing of someone that made that investment in Amazon or Microsoft or some startup company. That's the exception. The idea here is, long-term consistent behavior of saving and putting money away is what's really going to set you up for success in retirement. It's not super exciting on the front end, but it's something that can definitely help long-term. So thinking of what to actually invest in, and we'll talk about specifics here, but the question, let's say you're at work, or let's say you're picking up your Roth IRA investment list and thinking, how do I pick an investment or a couple of investments that really match? And the first question we always want to navigate through is, what's your risk tolerance? How much fluctuation, how much volatility, or how much up and down in the market from month to month and quarter to quarter and year to year are you able to withstand without keeping you up at night? If you have pretty high risk tolerance, great. You can invest in some, all stock mutual funds or some more risky investments. And if your risk tolerance is very low, maybe you think of seeing more balanced or conservative investment options. Obviously, the more risk you take, the higher potential return you're going to get. The more conservative you are, the lower potential return you're going to get. And that's where we get into the discussion about, do I buy individual stocks? Do I buy individual bonds? Or, is there any weight to doing a mutual fund or an ETF exchange traded fund? And for purpose of our discussion today, when you're starting out saving, our advice and my advice from this podcast in our office is look at the mutual funds and look at the exchange traded funds. Sometimes it's just a matter of the amount of money that you have to invest, and other times it's the amount of money you have totally invested. Our rule of thumb is we really shy away from individual stocks unless you've got about $100,000 to invest, and that seems like a lot, but you've got to get good, what we call diversification, or we've got to get the right number of stocks to put together so that you're not always over concentrated in any one area. And mutual funds, not only do they offer great diversification, you can get a whole lot of different stocks in an index fund or a target date fund, but what they also offer is efficiency of purchasing. One of the conversations I had this week was about Amazon. I had some clients interested in purchasing Amazon, and it reached an all-time high, right about $2,300. That's a lot for one share of a company. And when you think about, Bob's telling me to save 10% of my $30,000 salary, which is almost one share of Amazon in a year, that could be pretty hard to attain. But when we look at mutual funds, there's a much lower price threshold to get in, and then you've got a whole lot more exposure for individual investments. And prominently, we run retirement plans for many organizations, and they all are comprised of mutual funds. And you're going to have some stock-based mutual funds for U.S. stock. You're going to have international stock-based mutual funds. You have blended funds at stocks and bonds, and then you'll have target date funds. So there's I think, a lot of credit to investing in funds over individual stocks, and they can really achieve long-term goals for you. As we're looking about time horizon and risk tolerance, ask yourself, where am I in my career? Am I early? Am I just starting out? Do I have, more than 10 years before retirement? Or am I mid-late career and is retirement right around the corner? And that helps us understand what our time horizon is. How long you're going to work is one piece of it. And then when are you going to plan on accessing your funds? is another piece. And the risk tolerance and time horizon go together, I think, very, very well, in that the longer time to be invested that you have, the higher risk you can absorb, the more stocks essentially and more aggressive your investments can be. The shorter your time window and time horizon, what we hope is that clients have moderated their risk tolerance. And so think about where you are in your career, and perhaps you've got a lot in a retirement plan already. Well, the markets are down significantly from where we started the year. And if you've got 10, 15 years, it might make sense to talk with a professional and or a advisor and see, is there any credit to maybe moving from a more conservative portfolio to a little bit more aggressive, if it works with risk tolerance and timeline. And if you're starting out, you can certainly take a little bit more on there. But think about, when I ask them the question for clients, stocks versus bonds or funds, we always talk about where in life are you and how is your time horizon looking. And one great place that I always start the conversation with for any new investor, whether you're just starting out in your career and working for an employer with a 401k for the first time, or you're starting to save in earnest, is target date funds. They're a hybrid where you're going to have a target date. So you take your birth year, you add 65 or so to it, and that's the target date for retirement. Whether you actually retire then or not is kind of a gray area, but ideally this target date is going to say, okay, well, essentially if you're going to be retiring in the year 2060, we'll have more stocks or be more aggressive prior to that year. And about every 5 years or so, the fund internally will reallocate and it will sell some of the stock position and move to more conservative or balanced investments, so that early in your career, your target date is further out. Your fund is going to be more aggressive. As you get closer to retirement, the management of that fund becomes more conservative, and then in through retirement, you can preserve the wealth that you've built there. So if there's anything you're confused about by 1 and 2, look for the target date fund and find out some information about what those funds are offered. And again, you can find them at individual custodians like a Fidelity or a Vanguard, but also most retirement plans are going to offer a target date fund or a risk-based portfolio, moderate risk, aggressive risk, conservative, et cetera. But looking at these factors, again, in this circle, behavior. I hope that you're hearing me. Want to be a good saver and really prioritize paying yourself first. Percentage in stocks, small companies, value stocks, and then all the way down here, market timing, which stocks to pick, the news on CNBC, your brother-in-law, or your family. I mean, those are pretty minor if we don't have good behavior that really drives us to consistently prioritize saving and making retirement saving and paying yourself first a priority. I want to talk briefly about compound interest, and this is not diving into all the numbers. This is not a math class, but looking at the idea of what compound interest is. You're saving, you've got a savings rate, but then the account is going to grow, and hopefully there'll be some repayment, whether it's with dividends or reinvestment, either in a mutual fund or in a stock portfolio. And right there, at the very beginning, you see, we don't have maybe a lot of money invested in the market, and we certainly might not have a whole lot of time invested in the market. An example of this is, let's say you're saving $250 a month. And 12 months later, you've put about $3,000 into an IRA or a Roth, and you've got an average sense of return. We're looking at maybe $112 of return right there. Not too exciting at all. But let's fast forward and say we keep doing that over a 10-year period, and your $3,000 a month or $30,000 you've invested after 10 years with a balanced, moderate, middle of the road approach is likely going to be around $40,000 or $44,000. That's a significant investment gain, both from just the appreciation, but any other reinvestment that goes in from a dividend or a gain payment that comes out. And so I really appreciate this chart as, in the beginning, we're going to have small balances and we're going to be contributing an amount that works to our budget. It might be small, but over the course of investing, ideally 10, 20, 30 years, that account is going to grow dramatically by reinvesting the gains that you're making and continuing to have consistent behavior. That same $250 a month, 30 years later, could grow out to be an account north of $300,000. Looking at where we are and just being consistent. So don't knock the long-term strategy and planning the first couple of years, especially if you've just started to invest and we're going through a period that markets are down. I'd say now is a really great time to be purchasing and to be putting money into the market, since we've got a good discount going. And that's as a relation to where we started in January. Looking at how to seek and find advice. There are a whole lot of really famous financial planners and financial advisors in the world, as well as there are some local resources that you're going to have wherever you are coming into this. And I think first, I'm biased. I'm operating as an independent financial advisor. I'm a certified financial planner. I'd say, finding someone who's independent is real important, and serving in the role of a fiduciary. Legally, a fiduciary is going to put their client's best interest before their own of making money, before their company's interests of making money. And that's, I think, important in a distinction where there are a lot of ways for folks to make money in our business. But if you're interested in finding out more and seeking a professional, look for an independent advisor. And you can find them anywhere, and there are a lot of resources online. But ask in your interview with them, are you serving as a fiduciary, and are you licensed and able to provide advice for me? If you are participating in an employer plan, very likely you're going to have access to a retirement plan consultant through whatever company the plan is with. Maybe it's Principal, maybe it's Fidelity, maybe it's American Funds, but they're likely going to have some resources. And I know when I first started working, Willamette has a relationship with, at that time, a custodian, and they had someone that came to campus 4 times a year. And I went in and met and talked about how to save, how to invest, and just that 5 minutes really set me on a path. And then once a year, I was checking on it. Again, that's my personal story, but there are resources with your investment provider as well for you to learn a little bit more about what's going on with your account. Something that I'm very wary and cautious of is the cubicle copying. Sometimes we see that happen, and to remember, as you're getting advice, the reason you're going and seeking advice from the first two, a fiduciary or a professional plan consultant, is they're going to give you advice tailored to you. And in everything we do, we're not going to try and keep up ideally with the Joneses, but your savings goals and your saving rates are going to match the budget and the goals you have. And the cubicle copying, I think, can be pretty exciting and helpful. If there's, Larry down the hall who he's done really well with stocks, yet Larry down the hall isn't you and doesn't have your risk tolerance and your investment timeline. So take the extra advice that you get with a grain of salt, and I'm really excited to share that there are other professionals out there that you can work with. And I think this is a timely graphic of, you and your advisor, and then potential mistakes. A lot of the work that advisors do is in the numbers, but also a lot of behavioral coaching and helping you think through decisions and being a good counselor. So however you get advice, I think those are some really important pieces to focus on and when you think through who to ask and what they're saying. All right, that's 25 minutes of Bob talking at you. Lastly, I think if you haven't heard anything aside from the first 3 points on the slide, behavior is going to drive a lot of this. So I am excited to hear some questions and hear any feedback we have, and stick with you for the remainder of this. But when we look at clients, what we don't hear a lot of is the one comment of, man, I saved way too much. It's more common here, oh, if I only knew this 10 years ago, 20 years ago, 30 years ago. And so the focus today is really on that behavior piece. And how can we start with some level of contribution and then move forward from there so that you set yourself up long-term for some good success.
The one thing I would echo while we're waiting for questions to come in is just that notion of, I wish I knew then what I know now. So many of the pieces, being at a kind of a mid-career place investment-wise, there are definitely some moves that I started to make when I was, right out of graduate school, and some things that I did stick with, and I'm very glad I did. And then there are some other pieces that I did not stick with. And just hearing you kind of cover these, Bob, I'm just like, wow, I'd be in a different spot today if I had followed all those different components.
Thanks for that, Eric. And I'll add to that. That's not an uncommon piece of a conversation that we'll have with clients kind of mid-career or anywhere in career. And looking at the numbers, we're living longer, we're working longer. It's never too late to start or to readjust. And there's no harm in saying, oh, well, I wish I would have done this, but now I know, and now I have some resources and access. And And frankly, sometimes you get to a space where you just need more discretionary income to save. So there's really no one path for every single person. We're all going to be on our own journey here.
And our first question comes in from Irene Taylor. Do you have any options for actions by older investors in their 60s or even already retired?
That's a great question. Thanks, Irene. Yes, I think if you're, let's say 60 or older and still working, and able to save, that's a great time to be saving and figuring out what the best vehicle and what the best avenue is. But as well, anyone who might be past the accumulation phase and in the drawdown, recommendation is this is a good last 2 months to look back at where your accounts were and see and ask the question, am I invested correctly to weather some pretty significant volatility? And how do I feel with what my investments are? Obviously, we've come off the market lows of the last at the end of last month. So if we need to make adjustments, it might not be a bad time to consider that, as well as planning ahead to say if this continues for the next 12 months, the question I always ask is there enough cash? And ideally you're going to have 12 to 18 months if you're taking regular distributions from accounts. And if the answer is, wow, yeah, I've weathered everything and I've done well and I'm significantly cashed up, then potentially you could see some ways to readjust a portfolio and make some investments that you might not need for the next several years. But I think, again, back to that risk tolerance and timeline, ask those questions of when do I need the money? And then what is my level of variance, or what's the risk I'm willing to tolerate between now and when I need to start accessing these funds?
Natalia has a question, and that's which yields the best results, 401k with employer match and contributing after tax versus a Roth IRA with Charles Schwab?
That is a great question. Thank you so much for asking it. And I want to separate it because what I hear is a question about return and a question about account types. And I want to help clarify the difference between the two. Your IRA or a Roth IRA or your 401k are all types of accounts, and they're, I think, great vehicles to save in. And then once you figure out where you're putting money, you've got the option to pick investments inside those accounts. So the answer to your question is really how aggressive do you want to be, and what are the investment options in those individual investments? And the short answer is it depends. If you've got individual stocks or a pretty aggressive stock exchange traded fund or mutual fund in the Roth IRA, that might return a lot higher of a yield or return every year than a target-based mutual fund would in your 401k. So when you think about risk tolerance and timeline, think of the investments in those different vehicles and those different account types. And while we're on the subject, our rule and advice is usually assets in a Roth, and whether that's in a Roth and a 401k, which a lot of companies have access to these days, or a Roth IRA, those are generally some of the most valuable retirement assets and have the longest timeline. I'm going to advise clients to take from their pre-tax, their IRA, or their pre-tax 401k account balances before they tap into those Roth IRA balances. So in that sense, as you're thinking about where to put your most aggressive or long-term investments, would always advocate that those are probably pretty good to go in a Roth or a Roth IRA.
Here's a question from Winnie. Can you go over one more time what pay yourself first means? I think I missed that explanation. Thank you.
Absolutely. And great question. So ideally, if you got money coming in, you're going to pay taxes and those pieces first, but then we've got our net income. Say it's $2,500 per month. Before we start to go out and buy the non-essentials, say the dining out budget or the discretionary vacation funds or really the play, what we don't necessarily need but could be really nice, we always want to work into our budget. How do I pay myself first? Is this an earmark if I'm saving on my own because I'm self-employed? Is this, the first $250 goes into my Roth IRA? Or is it if I'm employed at a larger organization, making sure that I've got automatic salary deferrals set up for 10% of my wages every single month? But making sure there's a plan to always say, when I get paid, immediately I'm going to put money away for myself. I think that's a very important strategy in all this. Ideally, start with that emergency fund, then begin something with your retirement plan, and then save for other big purchases down the road. But where we see clients get off track is, and this doesn't always happen, we've got a big expense. I got to replace the roof or clean it, or I want to do new floors, or none of these things are necessarily mandatory, but we want to think ahead through, how do I save the cash and how do I make sure that I've got the access to the resources when I make those decisions? And retirement's going to be like that. It's not going to happen for a long time for some of you, but wanting to pay yourself first and to save a little bit so that you have options and you've got a little bit of a nest egg to make decisions after you want to stop working.
All right, Bob. Catherine says, thank you for this helpful discussion. And she asks, could you please talk about how paying off student loans fits into your savings plans?
That's a great question. We didn't touch on debt, but I think that goes under the budget category. And debt, there's many different types of debt, and some is good debt and some is not good debt. Low interest debt that I would put in the good or necessary category: mortgages, some auto loans, and student loans for sure. And ideally, what you're doing is you're leveraging yourself, you're borrowing, you're getting an education, and then that will help you reach into the career that you want to get into. Unfortunately, student loan debt is just crazy. And so the advice there is, look at ways in which you can structure payments that fit into your budget. And I don't ever encourage clients to worry too much about paying it off faster if you have been able to leave it as it is. If you reconsolidated, there are some tricky issues around that, but if you can leave your student loan debt where it is and pay on it, it's usually going to be at a pretty low interest rate. And sometimes if you do pass away, that debt is usually forgiven. So you've got a lot more ways to navigate that. And then some folks are wired just to want to pay all their debt off immediately. I'd say, well, lump it into your budget. But in terms of paying off student loans, I'd say it goes hand in hand with paying yourself first. And I wouldn't advocate overpaying at the detriment to saving into a retirement fund, with the hope being that you do pay the loan off. But I know that everybody's going to come at this a little bit differently. So if you can get into a job where there's repayment or forgiveness, seek out those opportunities. And long-term, hopefully that there is some income growth for you, and you can prioritize and add to paying off those balances. But I would put it lower on the list of prepayment debt than something like a consumer loan or credit card debt that has a really high interest rate and is much harder to get out from under.
All right. Thanks, Bob. Your friend Renee is really happy to see you, and she is coming to us with a two-part question. Can you repeat about how do you know who is credentialed to advise or not? And then the second part is, I'm thinking of relocating and have my current investments with an agency in Washington. How does that transfer of funds management work? Is it worth looking for someone new?
Perfect. Okay. Well, hi, Renee, and hello from Olympia. And hopefully you can relocate back here and we can hang out, because that would be fun. I know Renee from high school. And so these are really great questions. Looking at how to pick somebody, I think all three of us, Barry, myself, and Matt, are certified financial planners. If you go to CFP, search for certified financial planner, I think CFP.net, you can go online and they list all of the registered planners in the world. But when you're interviewing, I think it's real important that you have some sense of trust and ask. Either they're going to have something on their website with their credentials. Everybody has disclosures up the wall, but ask, how long have you been doing this? Are you licensed? Do you serve as a fiduciary? Are you a certified financial planner? And these questions are not anything new and shouldn't be hard to answer. And then, use your gut. And if it's a good rapport and you feel like you can build a relationship and they're able to work with you with your specific questions, that's great. And ideally there shouldn't be a cost to have an introductory meeting or to get this information whatsoever. And the second part, I believe, was figuring out where assets can transfer. And it's pretty easy for assets to transfer between different custodians. And it's very similar to moving money ACH between bank accounts. So there's a real big system out there, ACAT system, and it moves from, maybe you have money at Vanguard and you want to move it to Fidelity, or maybe you have money at Vanguard and want to move it to Charles Schwab. Those systems can get set up as long as you give written authorization to an entity and they sign the transfer paperwork. The receiving company will have that transfer paperwork. They'll set your new account up and then can bring everything over. And if there are issues with securities you hold, that will be something that you'll navigate through. But it's a pretty easy process. Where we get a little bit tricky is going from the US to an international account, or from an international account to the US. And if that's a question, I generally think asking whoever you're working with upfront, letting them know where the funds are originating from, and working through those details before a transfer paperwork is signed can be really helpful. It can be done, but not always in the easiest way.
All right. Renee actually has a follow-up question, if there's time. Do you know how much fiduciary financial advisors generally charge? And is that something that she should look at if she's planning to change advisors?
Yeah, absolutely. I would be curious. I think it's always good to do, like, you take your car in for service regularly, and you get your home inspected or appraised, or you're going to sell. Just kind of look under the hood. And there's a cost to all of the work that professionals do. And you're either going to pay a commission, which is more rare these days, or you'll likely pay an annual management fee. And so the first piece is to look at your maybe December statement and figure out what your total commission or management fee was for the year prior. And from our perspective, I think, as a fiduciary, that's the way our firm is paid. And we really advocate that hopefully no one's paying more than 1% annually of the assets being managed. And ideally, it could be a little bit lower than that. But every firm is going to have different offerings and different services. So don't take just my word for it. I think it really depends on, am I getting the value for what the cost is? And that's the question you should ask. And also identify what those fees actually are. And if you feel good about it, great. It likely is going to be a worthwhile relationship. So having that question up front, and usually our fees are going to always be posted in disclosure documents. Sometimes, the stated fee schedule is there, but also as independent advisors, there can be some variance of saying, well, I really only want to meet once a year and it's going to be pretty passive, but I'd like a professional. I don't want to pay 1.5%. Is there some way to work with us? And so I hope be encouraged to have that discussion, but it's one that should be, it's easy information for advisors to share. And really, ideally, if you're paying 1% on the management side, then the other piece to this is, what are my fund fees? Because every investment is going to have some sort of a cost to it. And that should be a question that your current folks can answer for you very quickly of all in, how much am I paying? And those fees don't go usually back to the advisor, but they are in there and are paid to the fund company before your returns. So it's always a good idea to just ask and understand what those are, and who's getting compensated and what work are they doing for me.
Aaron also is saying thanks for the talk, and this is one of those magic number kind of questions. How much money should people save for retirement, and is it important to keep this figure in mind while saving, or not so much? Is it about the number, and is there a magic number, or I would imagine that's pretty individual?
It is very individual. So thank you for joining us. And that's a really, really solid question to kind of capstone everything on. There is, and it's a math problem. If I know your tax rate and when you're going to die and what you're going to spend every single month through retirement, I just work backwards and give you that number. We don't know what that is. And I think it's very easy to hear comments from others, and even other very famous financial advisors who say, you've got to have $1 million, or you've got to have $2 million, you've got to have X, Y, or Z, and then you've got to have so much in real estate. Those are great numbers, but ultimately in the financial planning we do, ask questions for clients about in the future, what is your income going to be, and then how do we save to it? And it could be maybe $500,000. It could be $3 million. It really depends on what you're going to be saving and what you need to do. And because we don't often know that answer right now, at least I don't. I mean, I'm going to be doing this job hopefully for the next 30 years and retire well past current retirement age. The idea is I do have control today to save some of my income. And my goal has been to save at least 10% of my annual income and increase that 1% per year. And doing that will help prioritize and create a really sustainable behavior. And then in the future, as you are working with a professional to refine and answer questions, or getting online and running through the numbers and figuring out what you need in the future, you'll be able to identify exactly what that number will be for you in your specific situation.
All right. How you doing, Bob? You have time for 3 more questions?
I do. You bet.
Fantastic. All right. This one's from Winnie. I've changed employees over my career. I think that's employers over my career. So I have retirement accounts in 2 places. Is it better to roll over one larger balance at my current employer or leave them separate? Or roll over the former employer 401k fund into an IRA or Roth IRA account?
It will depend on that former employer, what type of money it is. If it's pre-tax money and you roll it into a Roth IRA, there's going to be some tax consequence because obviously that will be seen as taxable income. It might be good for your situation, but the entire question is really helpful for navigating what a lot of us are going to face is when we change jobs, what do we do with these old 401k or retirement plan balances? I think the first piece is, and Barry mentioned this yesterday, is really thinking through how you want to organize your finances. A lot can be said, and there's a lot of credit to simplifying and consolidating different accounts. And to do that, we've got 2 options. The first is, as you go along in your career and have different jobs, to roll funds over into an IRA or a Roth IRA. If you've got an advisor and that is something, or you like to manage them on your own, that might be a really great avenue. And then you can keep everything in one place, save for your current employer plan. The other strategy is to take everything with you. And as you move from job to job, you're going to have new enrollment paperwork. You'll have your old employer distribution paperwork, and then be able to fill out and roll everything together. And I think it's, if you really want to figure out investments and be able to have access to different investments that are in your current employer plan or your former plans, then perhaps an IRA or a Roth IRA is a really good step for you. But for the majority of folks, again, thinking about consistent behavior, consolidating in as few accounts as possible so that you don't lose track, and then can have a really coordinated investment strategy. And that's something that we worry about as well as legacy accounts that might be, just in a money market fund and not invested at all. You could leave a whole lot of return potentially on the table. So again, finding a way to consolidate down to the minimum number of accounts you need that get you easy to track and the right investments would be my advice for how to proceed.
Thanks, Bob. Okay, this question is from Annie, and she knows there's a lot of apps for saving and investing. Do you have any particular recommendations when it comes to those types of applications?
Yeah. I used to be the guy who every weekend would spend 3 hours in Excel chronicling every single expense. This is way before the apps ever came out. And that was just the worst use of my time because the plan and strategy I put in place wasn't sustainable. So as you look for an app, and I know that Mint is out there and there are others, but also a lot of the financial institutions offer their own individual apps for you to save. When you do pick an app, make sure that your strategy to figure out your budget and to manage your funds is something that really complements your life and where you're at. If you want to spend 5 minutes doing this every day or 10 minutes doing it every week, go for an app that's going to be easy to use, that you can remember, and you can prioritize. And if you want to really get into the weeds and do a whole lot more planning, you can go up from there. But I think the one we hear prevalently is Mint is a good app. Again, keep in mind your data is going to be shared, and so if you're comfortable with that, great. But then there are also other ways to save, such as Robinhood and Betterment. And talking about those apps, they're great because you get to prioritize saving a little bit here and there. My concern as a fiduciary when we're talking about retirement planning is the way in which we're saving. Ideally, what we want to do for tax efficiency is put money for retirement into either an IRA or a Roth or an employer plan. Investing in those types of vehicles are going to allow us to avoid paying taxes on any gains until potentially in the future we have to remove money from those plans. If we've got an individual investment account, that's going to be taxed every year, and it's just not necessarily going to be as efficient. I mean, yes, it's a great vehicle to complement, but when we're thinking about how to start out saving for retirement, definitely want to prioritize the tax efficiency plans.
Natalia's sneaking this question in under the wire. What investment vehicle would you recommend if you're planning to make a large purchase, for example, an investment property, in the next year or two? Is a money market account a good idea?
Excellent question. And Eric, I've got us down for another 10 minutes. So if we've got more questions, I am happy to keep answering them. with this question, we get it a lot, especially with where real estate was a couple of years ago, and where it is today. And I'm always excited to help clients navigate diversifying outside of the stock market. And when you're thinking of timeline, ask yourself, do I need these funds in the next 3 years? If you need, and this is Bob personal CFP advice, if you need money in the next 3 years, I would never advise a client who comes to me with that timeline to invest in anything in the stock market at all. Too much volatility and too much risk. A money market fund is a great vehicle. I know that right now with the Fed reducing interest rates, money market returns are way lower than they were even 6 months ago. But the idea is not to get a huge return. The idea is to secure your capital for a very capital intensive purchase like real estate. So if you know there's no doubt you're going to spend X number of dollars within a few years, for sure find a very safe and secure vehicle. And I wouldn't necessarily suggest a bond fund over a money, I would say money market fund or a CD, whether it's through investment brokerage like Charles Schwab, or you go to your financial institution, be it a credit union or a bank or an online entity, will have a money market for you. But yeah, absolutely want to keep that powder dry. So when you get ready to make your decision, you don't have any risk of losing those funds.
Schaefer has a question that's a little more personal to you, I think. Mm-hmm. What is the most rewarding part of your job, and what's the most challenging?
Mm-hmm. Mm-hmm. That is a really, really good question. These are all great questions. This must be Willamette. The most fun I have is every single day I get to teach clients. I get to come in and be an advisor and be a counselor and help think through sometimes very simple questions that have a really big impact. And sometimes it's a really complex question of how do I navigate a business sale? How do I take care of my employees? How do I help them move their retirement plan forward to the next entity? And then how do I keep my family intact? And how do I leverage the resources that are from the business or the proceeds from the business sale? And in every single day, the reason I'm doing this job is fundamentally, I believe the capital markets work over long periods of time. That is it. It gets me excited every single day. And then it's helping clients navigate it and breaking it down and being a teacher. And every single day is different. And conversely, what keeps me up at night is worrying about my clients. I want to give them the best advice, obviously as a fiduciary, prioritizing that. And sometimes they don't listen. That's okay. It's allowed. I have to give them the best advice. They're the client. They don't have to listen to me. But I do take pride in the work I do. And sometimes I worry and think, gosh darn it, I wish I would have been able to reach or say something better. But in the end, there are many more rewarding moments than not on this journey.
All right. That looks like all the questions we have, but there is a comment that I wanted to read. I want to just make sure you heard this, Bob. Haley had to leave 30 minutes early due to a short lunch break, but said thank you in all caps. Thank you so much, all caps. This was a really helpful and good use of 30 minutes to think about finances. I thought your level and depth of information was great for 30 minutes. Thank you so much, Bob, and thanks to Willamette too.
Excellent. Thank you, Eric, very much. I know that there was a whole group that got us here. I want to thank my co-presenters. Barry, you did an excellent job yesterday. I know Matt will have some really great advice for us tomorrow at noon. And just really appreciate being a part of the Willamette community. It's been great. So thanks everybody from the office and the staff and the community who's here. And thanks for joining us. This was really fun and appreciate your time today.
Right on. And thanks very much, Bob, for this excellent and engaging presentation. Hopefully our audience enjoyed and learned from this presentation, which from the comments and the questions, it certainly seems like they have. And speaking of our audience, thanks for joining us today. If you enjoyed this presentation, please stay tuned as we'll be adding new content weekly. Please share your feedback with us and suggestions for additional content to alumni@willamette.edu. And then thanks one more time to our presenter, Bob Heck. You were excellent. And please take care, everyone.
All right. Stay safe. Hope everyone's doing well. Wash those hands and safe. That's good. All right. We'll see you guys later. Thanks very much.